Welcome to Bar Charts Market and Close. I'm your host, John Rowland, Bar Chart Senior Market Strategist. And on today's show, we're going to look and evaluate critical moving averages, trendline breaks, gaps, and money flows. And I'm going to offer you my trade of the week, plus your questions. And to help me with all that is Bar Charts Twitter Tom and our Mr. X. Hello, Thomas.
Hello, John. How are you?
Very well. And where are you these days? I think you're pretty exciting to hear.
I think I'm in a place maybe none of our viewers have heard of, John. That is called Kangaroo Island, off the southern coast of Australia. I actually saw a little one hopping around last night, John. But I'm gonna go out after this show in search of more kangaroos.
More kangaroos. Go in one of their pouches and go for a ride, right?
Absolutely. All right, guys, we got a jam-packed show. Before we jump in, I just want to remind everybody, if you're watching directly on our website, you want to ask a question, click Ask a Question at the top right. You'll see it in the orange color. If you're watching on our social channels, go ahead and ask those questions directly in the chat, and John and I will get to as many as possible. All right, John, so a very eventful week. The Nasdaq finally had a close below its 100-day moving average. That was something we were watching for. In fact, it had two back-to-back closes below the 100-day. First time that's happened since last year, John. What do you make of that action, and is it starting to worry you about the future direction of the market?
Well, let me start by first saying, give me my chart as well. That first disclosure is that I am long the February 6/17 Qs puts, but last night in the massive sell-off that we got last night, I don't know a lot of people are aware of it, I did buy a partial delta hedge when we filled the Qs gap at 590. So I just want to let you know I'm kind of neutral to the market right now. All right, so as a student of technical analysis, we rely on these reinforcing patterns or other tools. Now, some people would say that technical analysis, you're just being fooled by randomness. But you can see since about November, we have been holding or continuing to test this purple line, which represents the 100-day moving average. Now, if we look at a larger data set, Thomas, you can see how critical or how important this trend line has, because one of two things happens: is it holds the line and it snaps back really quickly, or it falls to the 200-day moving average. And if you look over, like the last 10 years or so, and you keep going back in time, you can see how it holds here, or that when it does fall, it usually does test that 200-day moving average. But it's about a 50-50 proposition. So what this is kind of telling me, Thomas, is that, going back to where we are today, I think this is going to set us up for heading into a period of even greater volatility than what we've been having, and or a period of kind of a consolidation, right? Until we recapture the 100-day moving average. And so again, I think until then, I think we're going to kind of just spin our wheels. But you can see how close the 200-day is. So I would not be surprised if over the next week or so that we do take a stab at that. But also would not be surprised if, by the time we come back, a week or so, that we're just hanging out above the 200-day moving average. But this kind of reinforces what I'm saying there. So here's a watch list of the Nasdaq 100, and I sorted this by year to gain, right? Year to gain, and you can see, when I did this put up this morning, it was actually 50-50. I think it's skewed just slightly, like 53 to 47. But you can see that half the stocks in the Nasdaq are up for the year, and a half are down for the year. So that's really kind of telling me, I think, more of the same moving forward.
All right, John. So let's move to one of the biggest individual stocks on the Nasdaq, and that is Google, which has been absolutely unbelievable, John. By far the best performer in my portfolio. But a cautionary, potentially warning sign, John, for those who own Google, you have an end of the road screener, and Google appeared on that screener as the largest or biggest candidate ever captured. So, what do you think that means for Google, John? And maybe you could also give a little background on the screener itself for those of us who are not familiar with it.
Yeah. So if you don't know where it is, you go under investment under bar chart screeners, and it's kind of ironic that the end of the road screener is at the end of the row here, but you can see what it says. It says that this really is one a screener that looks at markets that have very strong or extended uptrends, and then get kind of like this rug pull up from underneath them. And what usually happens with these types of stocks, there's a lot of different outcomes and scenarios, but what we normally see is, like, for instance, here's ServiceNow. And if I go back and let me put in a template here. So this has the 200, 50, 100-day, and 20-day moving average. So the 20 is the red, the blue is 50, the purple is 100, and the black is. So typically what happens is, you have this, this kind of this trend line, and then you get a trend line break, and then you get this gap. And then depending how the moving averages are stacked, in other words, if the 20 is above the 50 is above the 100, and or so on, usually what you get this violent movement through the 50, maybe to the 100, a base, and then a continuation to the 200. Here's First Solar, another stock that I've recently. But here you can see, we literally gap below the 20 and the 50, right to the 100, and then it kind of trades sideways on the 100, and now it looks like we're diving towards the 200. Here's Microsoft. Again, a little bit of different here, a little bit, not much. It didn't really gap through the 20 and 50, but certainly a big reversal gap. And then here's one of the best examples, I think, is PayPal. We can go back, and this was not a big gap, and sometimes this is what these gaps do, is right there, right, gap through the 20 through the 50 to the 100. Retest. Sometimes you get a retest, and then right through the 200. And that was really a good example. So here's your Google. Now, what is interesting about this one, and it's difficult to see here. Well, first of all, my candles are open to close and not close to close. So that's why you see a green candle. But let me change this to open to close to close. I got to change it up here. Excuse me. Yeah. Then I got to reset. Let's go. Well, anyways, you guys, just let you guys know here that you don't see the gap, right? Because we're on the daily chart, and that is because because of what Google represents. And I think this kind of this programming to buy the dip. But what I've done here is I've gone down to a lower time frame. Here's a 30-minute time frame. And you can see this was the opening candle, the 9:30 opening candle. You can see this is a green candle, right? It opened here and closed there. And again, that kind of that programming of buying the dips in a stock like Google. But there is that end of the road gap. Now, this red line here, if we went back to the daily chart, would represent the 50-day moving average. Now, we did this discussion yesterday when we were setting this up, and we both of us was like, oh, well, maybe this market is going to really move lower. But it is very ironic, again, for people who, put down on technical analysis, that Google today literally is just hanging on the 50-day moving average. So, I think you have a question for me, right? On basically on this one, right?
I do, John. And it's a question I want to know. And it's a question I think everybody else wants the answer to, John, which is if you own Google and you've been enjoying these gains, would you sell that position based on the results of the end of the road screener?
Yeah, so it's, you got to really remember your time frame or your positions and your goal as a trader. If you're a long-term investor, which I think you are, then you have to kind of look at it in the big picture. And if I look in the big picture, what do we see? Well, we still see Google making what? A series of higher highs and higher lows. And yes, below the 50 would be concerning for me. Now, one of the templates that we have available to us under templates, go under bar chart templates, is one that was created by Jim Van Meerten, and this is called his long-term stop. And what we can see here is that there's a couple data points. First of all, these outer lines are what we call turtle channels, 50 days. And then this dotted line is our trend seeker, which is kind of a momentum trend identifier. And then the blue line is the 50-day moving average. And you can see that probe or that breach of the 50-day moving average yesterday signaled the trend seeker, our proprietary trend identifier, from a bull or an uptrend to what is called a hold. So again, at this point, if you were a long-term investor, you're not adding position, you're probably not taking off your position. But the 50-day moving average is in play. Now, Jim would probably tell you is that if we go from hold and below the 50-day, and then here's this little green dot right here, which is around, it looks like it's around 318. If we got below that, then the trend seeker would signal a sell. And so for a longer-term investor, that might be your clue or your permission to lighten up on this trade. Now, Jim might say he would keep a hard stop until we made a new turtle channel low. Now, in Wednesday, we did a webinar about exits styles. And one of the things that I showed was we could use technical analysis for, let's say, day traders or swing traders. And one of the things that I noticed on Google for me would be two things. Is that, first of all, when we get MACD crossovers, that's kind of telling us that there's a change in momentum. Now, I'm not worried about MACD crossovers when we're above the zero line. Notice that there was a MACD crossover here and a MACD crossover here. That's just telling me momentum is changing. And even this one here where it fell down low, that's really kind of a correction to me, right? Or if I have a crossover and we continue to see prices still go higher, the crossovers are at higher, that's just kind of normal market fluctuation. But when I get crossovers, I get a crossover, then I get another crossover, then I get another crossover, and I'm in the positive above the zero line. And the market is not really, it looks like it's trying to make new highs. This is kind of a negative divergent. So this would be permission for me if I was a swing trader or a momentum trader to exit this trade. And certainly you can see the negative divergence here in the RSI, Thomas. So I think for swing traders, momentum traders, short-term traders, this is really a sign that momentum has waned. For long-term investors, right? Google is the big oil of AI, and you could almost put it in the robber baron category of monopolies. And so for me, I think if I was a long-term investor like you are, I would be waiting to see if we see a series of new lower lows and a more directional price movement.
All right, John. So there was a huge unusual options trade that happened just a couple days ago, I believe. You noticed it, and it actually happened in the consumer staples ETF. The symbol is XLP. So looks like, John, 150,000 of the June 80 strike puts traded, total premium $18 million. So, John, what do you take away from this individual trade as it relates to consumer staples sector, and what do you think it might mean for the broader market?
Yeah. So when I first saw this trade, I wanted to go away to it and see, you know, you know, who is initiating this trade? Is this a put seller or a put buyer? Both of those would probably be slightly bullish. I just was curious, but it was difficult to tell. But this was definitely a deal that was done in some kind of back office, because the trade was done and then it was reported to the exchange. Because first of all, somebody who's going to try to trade this particular ETF on this much volume would never get off 150,000 contracts. But so what I did was I went right to the chart, right? And which is interesting. Here's the $80 strike value right there, that blue line. And you can see, hang on, what's going on? Give me a chart change here, brother.
Give me 1 second here, John.
Yep, I got you. No worries. Yep, there we go. Perfect. So we can see that this is right around where, the market had this huge breakout level. And I think that is really significant. So to me, this seems like it's more of a long hedge or long hedge protection. Somebody who bought into this sector, not a large trader or a fund. But I think the significance here, and I think this is the question you ask, is that what this really represents to me is sector rotation, a strong sector rotation. And I've shared this chart with you guys multiple times. And you can see that at bull market tops, the sectors that start to become more active or more profitable are basic materials, energies, and staples. Now, to kind of reinforce that, right? So again, let's go to help me hang on here a second. Let's go to stock performance. And I'm going to scroll down here, and here are the 11 sectors. But here's consumer staples. Notice how strong, how many stocks in, let's say, the critical 20-day, 50-day, 100-day are above the moving average. Look at energy, literally 100% across the board. And materials, again, super strong, super strong. So this is a confirmational indicator that we are in a secular rotation, and that these stocks are doing really, really well. Matter of fact, that XLP is at an all-time high. So the lesson here, I think, is how we can read the road, the roadmap or the tail of the tape to tell us how to get ahead of the curve, right? Because the narrative all week has been, the market's going down and everybody's panicking. And yet here's three sectors that are extremely, extremely strong. So, Thomas, the question I ask you is, what do consumer staples, energy, and materials have in common?
Well, let me think about that for a second, John. I would say that they're all physical items, and they are also things that AI cannot make.
Very good. Awesome. Yeah. So it's really where the market is moving away from that tech AI, and it's looking for, alpha opportunities. And I would add, that is also a lot of these stocks offer really high dividends, especially in the perception of a falling interest rate market. And the other thing is that they are guaranteed return in a fearful market where growth and valuation have now become a question mark, right?
Absolutely.
Okay.
All right. So, John, there's something that I've been tracking for a while, and I know it's being talked about in the media as well, which is, why are software stocks doing so bad? Now, here's a chart, John, which shows software's relative performance to the Nasdaq. Okay, and you can clearly see that software stocks are just getting absolutely trounced by the rest of the Nasdaq. In fact, underperforming at the biggest margin this century, John, since 2000. There's an idea, John, that maybe AI is quote unquote killing software stocks. Do you think that's happening, or do you think this is just one of those things where a certain area underperforms and it's not necessarily the death knell?
Well, I think it's the combination of what we just talked in the last segment is that this kind of this sectoral rotation, market valuations in the tech AI space have gotten a little bit ahead of itself, and people are taking profits and kind of looking for better opportunities. And I certainly think there have been news stories that have been related to AI about how swiftly AI is changing and how it is it is changing the world of software. But I think this is a lot more of a throwing the baby out with the bathwater. So here again, let me look at my chart here. So yeah, I mean, boy, this looks like a market that is literally, falling off a cliff. Now, in a technical aspect, let's kind of look at this from a Bollinger Band, which is one of my favorite tools. I mean, that is way oversold. That is probably in terms of a Sigma event, I mean, we might be talking about a 3 or 4 Sigma event, but I mean, that is just unusual. So I think the market is way oversold and is due for maybe even a dead cat bounce here. But, if you look at, again, this is all the stocks that are in the IGV, which is the ETF for software. I mean, this is just a sea of red. There is relatively little green or anything positive in this space. But I think what we need to do, if you are looking at this space and you're thinking that there's a trading opportunity or maybe even an investing opportunity, I think you need to start thinking about software companies that provide a niche, or look for software companies that are, let's say, buffeted from AI. Now, there's a lot of companies out there, and I don't want to single anyone out, but a couple that I was thinking about was like Symbol Team. You got Zoom. There's a company IDCL, which is a kind of a mobile software company. One of the things I do, I live in a cocoon here. You guys see me. This is like a little jail cell they keep me in. Barchuk keeps me in. They don't let me out. But I asked my kids, I was like, what software do you guys use at your companies? And, one of my daughters is a physician and the other one is in HR. And one of my son-in-laws is an engineer, and another one is in sales. And they all said they use Salesforce, right? CRM. So, those types of software companies, I think, will survive, right? They'll be the winners. And I'm sure there's going to be a lot of losers. But I have been investigating this space, and I got to tip my hat to Barron's, and they beat me to the punch on this one, is that AI's agents, this disruptor they're talking about, need security too. And that's where I was really thinking about. I think that's cybersecurity software is something that AI will not be able to eliminate. And in this one, they talk about this company, OKTA, which does that. It creates these doorways of letting companies create, cybersecurity. Because think about what an AI agent has assets to all of your data, right? And that is kind of a security risk. But if we look at the chart on this one, again, tradable versus investable, right? So yeah, this stock has been, since about September of last year, has been below its 200-day moving average for quite a period of time. That's not really a great investment. But we did get a bit of a capitulation sell-off back in December, and then notice that in the recent wave of selling in software, this one did not make a lower low. Now, which is interesting, I drew this little red line here based on an area that we go back to 24, which I would consider an area of demand or an area of support. And again, that probing down, and now, we're not getting there. So if you go into this stock, tradable, right? And we look at, let's say this, I think this would be a really good candidate for naked puts, because what volatility is really high right now with the fear of software companies. And if we go, let's say, out to like a March monthly, right now, that's 42 days out, but they're right on the cusp where theta starts to increase. you could pick any one of these strikes that is inside of that demand zone and notice your potential return if you don't get exercise, right? If you do get exercise and it does go down into that demand zone, well, then you're buying that stock at a discount. But from the tradable to the investable side, well, then what I would be saying is, look what is happening to the 50-day moving average, right? The 50-day moving average is starting to turn up. That's a positive sign. So if I was an investing trader and the fear starts to wane in the market, this is probably one of those baby in the bathwaters stocks. And that once we get back above the 50-day moving average, that might be enough permission for an investment in this one. Again, this is not a recommendation. It's something that Barron's recognize. I just think the play really makes a lot of sense to me.
That's great, John. I really like that angle and that story there.
Okay.
All right, John. So we had a lot of people who watched last week, and they threatened to egg your house if you don't do Trade of the Week again. So we're gonna bring that one back again, John, due to popular demand. We don't want to put too much pressure on you, John, but is there a chance you've got a good one for us this week?
Yeah, I think I have a really good one this week for you, and that's why the picture here is kind of this petrochemical picture. So for quite some time, those of you who know my background, I come from the energy space, particularly natural gas, that I've said that I've been long-term bullish on the natural gas space, and that, I've talked about stocks in that space. And one of the stocks that I have mentioned before, well, here's my, hang on, let's do this. Here's a watch list that, some of the stocks that we have touted before in the energy space. And the one that I talk about a lot is EQT. This is a natural gas producer. Basically, they're in the Marshall space up in, Pennsylvania, Ohio. And what, I learned a lot of things from Jim Van Meerten in terms of long-term investing. And what I noticed with this one was that, it wasn't really responsive in terms of the beta to the natural gas price. And in other words, when natural gas fell, it fell a lot harder. And when natural gas prices rises, it was very slow to recover. But what Jim taught me is, you go into you look at the weighted alpha, and when the weighted alpha does not outperform, let's say, a benchmark. Now, in this case, the benchmark could be the energy ETF, or it could be its peers. EQT, you can see its weighted alpha is only 10, and that was really kind of the sign for me as a long-term investor. I was like, hey, you know what? I think maybe I could do a better job. So I'm not going to go into how or why I got out of it, but if you watch like one of my webinar on Wednesday, there was a lot of significance about what was going on here, and I basically got out of that position. But I want to be exposed to the natural gas sector, and this week, Devon Energy and Coterra. So if we look at natural gas producers, you got EQT, you got Devon, and you got Coterra. They're basically 1, 2, and 3 in terms of production. Well, Coterra and Devon are going to merge in a pure stock merger. Now, I think it's 54, 64, 46, something like that. But there's not going to be no cash, right? Typically, when you get a merger, you get the company that buys, their stock price falls, and the one that's being bought, their stock prices rises. But this is a pure merger, right? And they're going to be become the largest natural gas producer here in the continental United States. So I like that as a fundamental story. But what I really liked about this trade, as you know, as me being a swing trader, more of a momentum trader, is this breakaway gap, right? This breakaway gap from, right? You can see where we had been, in previous highs, previous range, and we're breaking out of this. Now, I'm just going to kind of show you this trade, which is kind of interesting. Again, if you're not using this tool on the day of action for you, this template, this 13 EMI pivot, which is part of our bar chart package of templates. So here's the breakaway, right? Here's the morning candle where we opened up. And the rule basically of breakaway gaps is you wait for a price to either get above the opening price or the high of the opening candle. And that would have been, at this 42.60. Now, I was working and things were going on and I wasn't really paying attention, and I kind of chased this one a little bit, but that's okay because this is going to be a long-term investment. So I'm in at 42.87. But again, here's kind of that confirmation of breakaway gaps and goes. I really like these types of setups. So, again, I use my skill as a swing momentum trader to find a trading opportunity or better timing for my long-term portfolio. But let's kind of back up here for just 1 second. Is that think about what we just talked about, right? The momentum, sector momentum that we just looked at, right? Energy and the understanding that capital flow is coming out of tech and into energy space. And so, again, let's look at our alpha. And this one has a super strong, nice alpha, 43, where the S&P is probably like in the mid-20s. And in the sector group, is still in the mid to low 20s as well. So this is an outperformer in this peer, and I like the fundamentals behind this one. Okay, so that's my trade of the week. Do you like that trade?
I do like that trade, John.
All right, brother.
Great job. All right.
How do we do on time?
Just about right on time, John. Good job.
All right,
so that.
Go ahead.
Go ahead, John.
Tom was busting my balls all week. It's like, you better be on time. 5 segments. That's too many.
All right. So usually we jump into Q&A, John, but I just want to give a testimonial first because this is a really amazing testimonial. Lonnie says, bar chart changed my life.
Wow.
That's as high as it gets, John. That's as high as the praise goes.
I didn't need to do this job when I came to bar chart 5 years ago, but I came here because I wanted to share my life experiences. I wanted to share the skills that I have gained over the 40 years of trading. And boy, this is the real reason, right? Here's my payoff. And I really appreciate that, Alani. Thanks so much. That really encourages me. So thanks. That really touches me. Thanks. I'm kind of choked up.
All right. We'll give you a second to get your composure, John, while I go through the questions. All right. John, here's the leadoff question. Can you explain the concept of a delta hedge?
Well, it's really for options traders. If you're like long a put or a call, the delta, right? The delta that is attached to that particular strike. What you can do is if you're long a put, that means you're in technical terms, you're short the market. So if you think the market reaches a bottom in the short term, then you could go and buy the underlying to kind of offset that risk a little bit. And so you can see the 16s, the delta was around 62. So one option, it represents 100 shares, but this put in its delta tells you that your exposure is about 62 of those 100 shares. So you could buy 62 shares, and then you would be neutral to the market. Am I explaining this right? You're really more the option guy, right?
Yeah, you're on the close to the money there, John. Just in short, a delta hedge is reducing your directional exposure. So, for example, if you buy calls, right, then you sell stock to hedge. If you buy puts, you're betting on the stock to go lower, right? So if you want a delta hedge, you would buy shares in the underlying. So delta hedge can apply to options traders and other kinds of traders. It's basically just a way to reduce your directional exposure?
Directional risk, right? Because I had a lot of these puts on that were doing really well. I saw this gap here. Right? I saw this gap here, and the market had finished the previous day down. I was like, "Boy, I really feel like the market's going to go and hit this gap." But a lot of times, the market makes these gaps in overnight, right, in extended hours. So let me change this to extended hours. And again, I got to go down to a lower time frame. But there's the gap, okay, in that circle. And then here is the chart of the overnight, and I'm just going to show you, right? So I mean, there's the gap right there that we saw the daily, and you can see overnight last night the market fell in there. So I felt like, again, that the market had fallen too far too fast, and I felt that this was a good opportunity to employ a delta hedge to kind of offset the risk in case the market did what? Snap back, right? And one of the things I looked at going into yesterday, going into today, was I looked at the gamma exposure of the strikes that are going to expire today, and it's actually moved on because now we've expired, but the values was around 600 and 605. So I knew the market maker was probably going to move the Qs back up above 605, and that's exactly what it did. So I picked up 15 points on the Qs, but I still have the puts on as well. So I'll unwind this on Monday, and then we'll see what happens.
All right, John. So Microsoft has gotten absolutely killed. So the question that somebody asks is now a buying opportunity in Microsoft?
Well, we looked at Microsoft, right? We've looked at Microsoft a couple times again, and this is this idea of tradable versus investable, right? Microsoft's not going away, right? I certainly don't think so. If you want my technical opinion, I think it's way oversold. Have we fallen into that gap that we looked at this gap a long time ago, right? Yeah, I think in that sense, this market is overdue for a correction. But again, the buying just because a stock has fallen, or buying a stock that is below its 200-day moving average, or buying a stock where of its short and intermediate moving averages are still moving lower, is not typically a good sign. Is this a buying opportunity? 6 months from now, we'll probably say, yeah, it probably was. Probably because of this gap fill. But again, I'm going to wait for other clues. Maybe I'll trade this one, and then if I'm right about trading this one, then what I could do is turn a trade into a position, right? An investment position. Bollinger Bands, right? We got a big outside Bollinger Bands. Maybe we get a little bit of a mean reversion here. So I think there's a lot of technicals that says this is a buying opportunity, but you are doing a contra trend trade.
Okay. We got a question. How do you get a bar chart T-shirt? Well, usually those are reserved for special occasions. We might have some contests occasionally. So yeah, stay in tune. We'll make announcements. John, I think at one point we had an idea to launch a bar chart merchandise store.
Yeah, a swag store. Yeah. Yeah, we've been getting a lot of comments about my shirts recently.
Oh, we got a comment from a viewer, John. They said they've also been to Kangaroo Island back in 2018.
There you go. The dingo ate my baby.
Let's see. Just going through the
questions. I see a question
here,
about Devon and Katura merger. Does it mean there's going to be no Katera? Yeah, it's going to become Devon. The headquarters will still be where Devon is, but they will still have a presence in the Permian Basin, which is where Katera is located. But yeah, the parent company will be Devon. So,
John, we got a question on the U.S. dollar. I think it's honestly what we've talked about in the past. They said that every time it gets to support, it bounces. Do you think that's just going to be a continuing theme, or do you think it's eventually going to break down?
It's this battle between sell America and that safety, right? Or the safe haven. I was kind of surprised, to be honest. I had a little bit of a bearish sentiment on this one. I was surprised how well it did bounce, but again, here is our weekly, right? So all we really did was we bounced back up to the previous week's low. So, and that is typical when you break down off of a major trend line, you usually get a little bit of a retracement. And look at what's happening in the Qs. Look what's happening in Google, right? You break a major trend line or something to that effect, you usually get a little bit of a retest before the market moves in that direction. So I don't know. We'll see what happens on this one. Again, last week I said don't bet against U.S. and don't bet against the dollar. I did think we would fall into this zone, but I would not be surprised if the dollar returns on some kind of strength.
Especially, John, do you think the 10-year yield will eventually get to 5%?
Yeah, I've been on this one for a while. I think you guys know that last year I was kind of saying that by the end of last year, I thought the 10-year yield would be closer to 5 than it would be to 4. I did draw this out recently. This is the 10-year yield. I saw this reverse head and shoulders and this ascending wedge, and I thought that target-wise we did get up here. But I think what we saw this week, the fall of the 10-year note, was really, again, why the dollar got strong is that everybody got a little bit nervous about the stock market, right? Growth stocks and all that. And they rushed to the safety of treasuries, right? They had to buy dollars to buy treasuries. So that's why that's falling. So, this is a weird one because if the yield starts to fall, I don't think that's because the Fed is lowering rates. The yield's falling because there's something more ominous on the horizon. If yields start rising, I think that is actually a good sign for the stock market. I know that it would be counterintuitive until, let's say, we get to like 4.5 or 5%. So let's see what happens. So I'm kind of in the middle here on a lot of markets right now, right?
John, your thoughts on nat gas after its big sell-off?
I think we talked about natural gas to ad nauseum. It's all about weather now. I think you got another polar vortex next week, but it's going to be a lot short-lived. Again, I think if you're going to trade natural gas, the seasonal trade is probably over. You might get a late seasonal pop if we get some late weather. I think you got to look at natural gas from a long-term perspective and not from trading, the futures or oil right at this moment. Seasonally, between now and April, natural gas prices tend to fall.
John, at what point would you consider getting into Bitcoin?
Do I get to use your money?
Maybe.
Okay, let's look at this from just a purely technical aspect, right? Again, I will show you guys some, I look at all markets. I look at all markets from just a technical aspect. I don't care if it's, cockroaches or popcorn or, indexes. These lines have not changed. I've had these up for a long period of time. And so you can see where I thought the market would find some short-term support. Now, it did go through my zone, but if I come back and look what's going on here, it looks like, maybe it's right off of that low there. I did say this to Thomas in our production meeting. For those of you who follow me, there is a 3-candle drop developing here. So what we need is next week to have a green candle. And if next week's close is green, then the following week we can start looking to set up some type of trade. So until then, which is probably good because we're not going to be here next week, right, Thomas, as a scheduling note. So in 2 weeks' time, we'll have a setup for this Bitcoin. So let's leave it at that, okay?
I want to add one more point, John, because I wonder if this person saw my tweet. I tweeted something yesterday about Bitcoin. Can you add the RSI, John?
You want just RSI or you want MACD as well?
You can just do RSI.
Okay. We can do that.
And then yeah. Okay, so the RSI fell to a 16, John. I think it was on Thursday or Wednesday. That's the lowest RSI since November 2018. So about almost 5.5 years. And I just put that out on Thursday, and look, we saw a huge bounce today. Anything can go lower, anything can keep going lower. But when you see an RSI plunge that low, John, I think it's always important to take note of that.
Yeah, I mean, and part of the three-candle drop is of talking about capitulation. You can look at volatility. You can look at it in all different aspects. So yeah, could this be a mean reversion dead cat bounce, right? Yeah, I think there's a high probability of that happening now.
All right. Good job as usual, John. Quick housekeeping note, as John mentioned, we are off next week, guys. I think the Monday after that is a stock market holiday, so enjoy. We'll see you guys in 2 weeks. Hopefully we'll have some good stories for you.
Yeah, I think that'll set up. We're really closer to the February expiration, and there's a lot of things that are on the calendar that are going to come up by then. And plus, we'll be all the way through most of the earnings season. So I think we'll be ready for some kind of catalyst to come and get the market going. All right. So, yeah. Anything else, Thomas? Any other notes?
That's it, man. Good job. Good job as usual.
All right, buddy. Thanks so much. Everyone, Thomas and I appreciate you guys hanging out with us. I hope you guys got something out of today's show. I hope you learned a little bit, maybe even got a little bit alpha. And again, to Lonnie, thanks so much. I'm glad that we can make a difference in your life. That is our goal. That's what Bar Chart is about, to make you a better trader and investor. Until next time, the best of health, manage your risk, and the good of all trading.